Welcome to Smart Investing. We have all been shocked by the market reaction following Amazon earnings last week. So this video is going to tell you what has been really the earnings of Amazon. We're going to go through the income statement, the cash flow statement, balance sheet, the changes versus last quarter last year, the same quarter last year. You're going to see all the percentage change for each item. We're going to understand what has been the strengths of Amazon earnings, the weaknesses, the opportunity, and the challenges. We're going to understand why the market didn't react so well and why I think it's wrong, and what you should do from now, looking at the opportunity of Amazon being done by more than 8%. So stay tuned, let's get straight into it. So Amazon Q2 2025 earnings. You can see the income statement, consolidated statement for operation. You have the Q2 2025, that's the earning of last week, and you have Q2 2024, last year, same quarter earning. You can see net sales increased significantly by 13% to 167.7 billion. Actually, it's 5 billion more than what the analysts estimated. Can you imagine? 5 billion more than the earning, the sales consensus of the streets. And they are not happy. How can you believe that? Which company is beating earnings estimate by 5 billion? Look at that. They were looking for estimate of 162.2. They report 167.7 billion. So 5 billion more they beat sales. And they are not happy. Give me a name of one company that beat sales forecast 5 billion. Leave me a comment below. North America increasing. International increasing. AWS increasing by 17%. Of course, AWS is the cloud computing business of Amazon. It's not as good. The growth is not as good as what we've seen on Microsoft, which is more than 40% increase, but it's still a major player in the cloud computing. And that segment is going to keep increasing along the years because the AI trend is there. And Microsoft, although it's a leader, Amazon is very close behind it. So I understand that there are some disappointment about the growth of AWS, but it's still growing by 17%, you know. Advertising growing by 23%, subscription by 12%. So basically every single business line of Amazon is growing between 10% and 25%. That's an amazing feat for a company that is about $2.5 trillion of market cap. You know, we are talking about a large cap company, not a small cap company. So having this type of growth is just amazing for such a big company. You know, it's a no-brainer and it's very diversified. Look at all the business line activity. We have a diversified business. So this is like an incredible company, you know. And if you look at the operating income, 19.2 versus 14.7 is an increase of 31%. Your operating income increased by 31%. Your net income increased by 35%. 18.2 billion versus 13.5 billion. So 35% increase year over year for your net income. Can you believe that? Your earning per share increased by 33%. Goes from $1.26 to $1.68. It's an amazing result. And it doesn't at all justify the collapse of 8%, you know. Basically, revenue growth was broad-based and AWS accelerating due to its AI demand. Advertising surge on Prime Day, success and ad tech improvement. Operating income jumped by 33%. Okay. But last year it did, of course, 36%, but you have a higher infrastructure spend this year, so the growth is less impressive by last year. But it doesn't matter, you know, still 33%. Net income beat estimate by 35%, affecting lower taxes and investment gain. So what about the cash flow statement? Cash flow statement, again, the same. Operating cash flow increased by 12%. Free cash flow increased by 14%. And Capex increased by 30%. Of course, they are investing a lot into AI, infrastructure, and the improvement of the business with technology investment. So, of course, you have an increase in AI. But despite the increase in AI spending and infrastructure spending, you still have free cash flow increasing by 14%. That just tell you how strong the operating cash flow increase is and how strong operating cash flow is. So that's mean the core business of Amazon is generating huge amount of cash. They can afford to spend huge amount of money to improve their operational activity going forward, and more importantly, to be at the forefront of the AI revolution. I mean, operating cash flow grew on higher earnings and working capital efficiencies. Free cash flow improved but remained pressurized by massive Capex. Of course, Capex in 2025 is expected to be 105 billion. You see, for one quarter, they spend about 26 billion. And for the overall year, they expect to spend about 100 billion, and mainly for AWS AI infrastructure. But that's in line with all the major Magnificent Seven company. So there's nothing extraordinary in that. But also, you would expect a company like Amazon to invest for its future. You wouldn't be happy if the company wouldn't invest for the future of AI and technology improvement. Balance sheet item, you see cash item improved by 5%, total asset improved by 8%, liability increased by 10%, stockholder equity improved by 5%, long-term debt improved by 8%. So basically, still a very strong cash position, even though they are having a huge, heavy investment for at the moment. Asset growth reflect property and equipment addition to data center, and equity growth lack due to share-based compensation and buybacks, non-major in Q2. So key valuation metrics also is impressive. From Q2 2024, earning per share 5.5 on the trailing 12 months. So going for so far on the trailing 12 months, that's what we are looking at here. $5.5 versus 4.10% is a 34% annual growth rate on earning per share. Price to earning decreased sharply from 45 to 39 on the trailing 12 months, of course. EV to EBITDA decreased also from 20 to 18.5. Operating margin improved from 9.9 to 11.4. AWS operating margin improved. So it decreased slightly from 36% to 33%, but we saw it's mainly due to major investment in infrastructure of AWS. Return on equity improved from 19% to 24%. So basically, valuation remain at the premium, but justified by high growth of the company. If you have a PE compression post earning, and you have still a high growth company, then the PE is very justified, So market reaction after the result. You see the stock price, Amazon stock price slid by 8.3% on August 1st, 2025, closing at 214, despite beating revenue by 5 billion and beating earnings per share estimate. So basically, this erased more or less 180 billion in market cap in one day. And the share now is down 2.4% on a year-to-date basis. Why the market reacted so badly, Because according to what we can see here and there, mixed Q3 guidance. The guidance are always very important when you have company earnings. It's not all about what the company has done the last quarter versus last year. It's also what they expect in the future. And obviously, investors were not happy with the guidance. Guidance where 174 billion, between 174 billion to 179 billion. Beat estimate 173 billion. But operating income, this one was disappointing because they were expecting 15.5 billion to 20 billion, and midpoint on 18 billion, below the consensus of 19 billion. So basically, the revenue guidance were beating expectation, but the operating income guidance were below the midpoint consensus estimate. So, but 18 billion compared to 19 billion doesn't justify a collapse of close to 10%. Second of all, AI and Capex concern. So AWS grew by 17%. It's a very solid growth, but below some expectation. But by power chips, server supply constraint. So basically, AWS has more demand than capacity, with a 195 billion backlog, plus 25% year over year, but it could take several quarters to resolve it. So basically, they have more demand than the capacity they currently have. That's why they are heavily investing into the infrastructure to take more clients. So that means the 17% increase that you see in AWS business could be much more than that. Could be 20, 25%, even 30% like Microsoft. But the CEO is telling you that they have not enough capacity to take all these clients. So that's why the growth is not as impressive as you can see for Azure or Microsoft. So there were a lot of concern that Capex could impact profitability and so on and so on. But that's all nonsense, because you need Capex to improve capacity and to improve growth going forward. But if you don't spend all this Capex, or do you want to improve the growth ability of the company going forward? So this is all nonsense. Sometimes the market doesn't make sense at all, For the market sentiment, a tech sell-off, of course, you had the broad-based tech sell-off that happened on Friday and Thursday. And of course, you have comparison versus Microsoft Azure plus 29% growth. So it's like a relative weak growth compared to Microsoft. Microsoft, by the way, increased by more than 10%. Of course, a lot of analysts called the dip overdone and some raising target price to 271%. So basically, if you are looking for long-term solid investment, then it's probably an opportunity to buy the dip and just sit there, for long-term investment in Amazon. Amazon should be in every portfolio holdings. This is an amazing company, still growing by double digits, and it's not going to go anywhere in the next 5 years, next 5 years to 10 years. It's just going to keep growing and growing and growing. And if the AI revolution accelerates its growth, then and it's improve its margin and everything, that is a no-brainer for investing in Amazon. So what are the opportunities of Amazon? Opportunities, AI expansion. Of course, you have a lot of opportunity in that. Retail and advertising momentum. You have a lot of growth in there. Record Prime Day of plus 23% growth in the ads and 12% in subscription. Basically offering higher revenue and higher margins. International expansion is growing also very fast, 16%. And you have a lot of operational efficiency that could improve as well the operating margins going forwards. So, what are the main challenges for Amazon? Supply constraint, powers, and chip shortage limit AWS scaling, potentially ceding shares to Microsoft and Google. But the CEO noted that gradual improvement, but delays could hit 2026 revenue. But they are investing heavily in infrastructure, so these disadvantages should diminish going forward. Obviously, high capex and margins, 105 billion spent in 2025, risk diluting return if AI monetization lagged. AWS margin fell 3 percentage points year over year, signaling investment pressure. But this 3 percentage point is nothing, it's still 30% plus of growth, Anyway, competition and regulation, intensifying AI, rivalry, and antitrust scrutiny could slow growth. Economic slowdown might hit consumer spending as well. Overall, Amazon Q2 earnings show extreme resilience, but the dip create a buying opportunity for long-term orders and focus, and that's what you should remember from that video. This is an extremely strong company. The dip of last week is a buy opportunity, like it has always been for Amazon. Look at the chart of Amazon. Let's have a look at that. What are you afraid to invest in Amazon? Look at the last 5 years. It's a straight up from the low of 2022, and you have an increase. If you invest in the low of 2022, now you have an increase of about 200%. 200% in 3 years. If you look at the overall long term, you look at Amazon, it's a straight up. What are you afraid with Amazon? So basically, Amazon is a strong buy opportunity. So if you don't agree with me, or if you agree with me, or if you have any comment to do, please leave your comment below on the comment section. Please like and subscribe, help me to grow this channel, and stay tuned in this channel because I'm going to do the same type of very quick investment review on Apple. I will do also on Meta, and I will do also on Microsoft. So thanks so much. See you next time. Bye.